Welcome everyone to our program today. I'm Terry Maggedy, Chair of the Elder Law Committee for the Trust and Estates section. And the first thing we always do is thank our sponsors, because those are the people who we have a lot of gratitude toward, because they make, they're behind us doing what we need to do here to put on these programs. And our first sponsor that I'll mention is Nancy Sanborn and the Sanborn team. They're real estate brokers and professionals in all the areas that we work with: probates, trusts, conservatorships, real estate relating to older people. So thank you, Nancy and the Sanborn team, for being our sponsor. And our next sponsor will be able to address you herself, or Orit Gadish.
Thanks, Terry. Hi, everyone. I'm Orit Gadish, broker and owner of Geffen Real Estate. We specialize in representing trustees, administrators, executors in the sale of commercial and residential real estate. We're focused on adding value for our clients, whether it's a partial or a complete renovation. We first conduct our due diligence to determine the most appropriate value-add solution, and then we execute with no cost to the seller until escrow has closed. We also have a designer on our team to ensure the properties we're selling are appealing to buyers and are drawing on their emotions to allow them to offer top prices. We're not cookie cutter renovators. I'd love to connect with you, to get to know you. Please feel free to call or text me anytime. Enjoy your program, and back to you, Terry.
Thank you, Orit, for being our sponsor. And the next sponsor I want to mention is Marcine Klein at Glen Oaks Escrow, an escrow company that, again, like really all of our sponsors, specialize in the areas we deal with: probates, trusts, conservatorships, sales relating to older people. Thank you very much, Marcine and Glen Oaks. And our next sponsor is California Title Company, a title company that works in the probate field and has been our sponsor for a while now. Thank you, California Title Company. And finally, Manufacturers Bank, our newest sponsor, who also is a bank that works in the area of probates, trusts, conservatorships, fiduciaries, a very specialized field. And you hear me mention it with each sponsor, but it's important in our area to have professionals like all of our sponsors who know our business and know how to help us. And now, before we introduce our speaker, I want to mention our next program, which is May 9th. And the speaker is going to be Chris Wilson, longtime member of our bar. Chris not only is an attorney, but is a nurse practitioner, very active in the healthcare space, also involved with ethical decision-making with hospitals and other institutions. Chris is going to talk about some topics in healthcare decision-making. So that's going to come up on May 9th. And now I have the pleasure to introduce our speaker I've known for a very long time, Janice Cohen. Let's talk about jumbo reverse mortgages. Janice is a wonderful professional. Adjectives I think of just automatically with Janice are authenticity, caring, honesty, integrity, and super uber knowledgeable in her field. And those kind of things are like so important when you're talking about products like reverse mortgages, which should be part of anyone's portfolio who works in this space that we're in, the elder law, probate, fiduciary space. It's a must to know about reverse mortgages. And so Janice is going to talk about one particular aspect of reverse mortgages today, but she'll probably expand into many aspects of the field too. So for the next 55 minutes, I'll turn it over to Janice.
Thank you so much, Terry. I'm going to share my PowerPoint, and hopefully everyone can see it clearly. So I wanted to talk with you today about the role of the jumbo reverse mortgage program in Southern California and really particularly on the west side of Los Angeles, because what I've seen with my own clients is that on the west side are people who have owned their homes for many, many decades, and they have sort of an unusual set of circumstances vis-a-vis what they paid for their home versus the value of their home currently, and whether or not their spouse is still alive, what their aging in place needs are. And it's a very, very important program. I would say that in my business, probably 80% of the reverse mortgages that I do are jumbo reverse mortgages. And I do only reverse mortgages. I don't dabble in any other type of home financing. I work for Mutual of Omaha. And here are our disclosures, which my PowerPoint is available to all of you if you decide you want to look it over. So the topics that we'll cover today with regard to the jumbo reverse mortgage are the new age parameters for jumbo reverse mortgages, particularly in California, and I'll get into that a little later. A very unique program that I do a lot is a hybrid cash out line of credit program. We'll talk about how a senior can borrow up to $4 million on their home and the types of trusts that are acceptable for reverse mortgage lending. We'll talk about when there is a non-borrowing spouse involved and how that might come about. We'll talk about how reverse mortgages are recorded differently than traditional mortgages. And we'll talk about the significance of the step up in basis when the first spouse passes away. So I wanted to just mention three instances recently wherein I've been referred to a family by their attorney to do a reverse mortgage in sometimes a little unusual set of circumstances. I want to say, first and foremost, that the majority of the time that I am called upon to do a reverse mortgage for a family, it's because there is care needed in the home. The homeowner, the senior, wants to remain in their home, but they need sometimes upwards of $25,000 a month to pay for 24/7 care. And we all know it's a very expensive proposition, but in many cases, it can be more expensive to sell the home and to move the senior to a congregate care setting or to another setting. So recent legal cases wherein reverse mortgages have been used, in my experience, I had a call from a probate litigator. A partition action had been filed on the part of the ex-romantic partner who was with the homeowner for 20 years. He put her on title. And then, of course, the relationship came to an unfortunate end, and the homeowner needed to compensate the ex-girlfriend, which he did using the reverse mortgage. So that worked out quite well. And the homeowner was able to remain in his home, which is what he wants. I had an older couple who are divorcing. The wife wants to remain in the home that they lived in together for 40 years. And I'm sure you're seeing many more cases of gray divorce than in the past. It's an unfortunate phenomenon that there is a growing population of elderly couples who are divorcing. So by doing the reverse mortgage, the husband or the wife was able to buy out the husband to satisfy his demand for payout. and he subsequently quit claimed off title. Another instance where I have recently, which is a little unusual, recently used a reverse mortgage. I had a borrower. She was actually an elderly medical school professor, and she was driving her Prius in Santa Monica, and she hit another older person crossing the street. And she did not have umbrella insurance, and she was being sued by the victim. So she did the reverse mortgage, and the proceeds were used to pay out the victim. So a couple of facts about the jumbo reverse mortgages, jumbo reverse mortgage. We mentioned that there was a new age, a new minimum age for borrowers on the jumbo reverse mortgage, and that age is now 55 years old. And when this was first announced, to be honest with you, I did not imagine that the week that it was announced, I would receive a phone call from a 57-year-old person who's married to a 56-year-old man wanting to do the reverse mortgage. But, you know, sometimes it isn't well known that the general minimum age used to be for all reverse mortgages 62 years old. And the financial planner for this couple thought that a reverse mortgage might be a good solution. And when I first received the phone call from the homeowner, as I said, she was 57 years old. And I said, well, we really can't help you, but let's stay in touch. And when you turn 62, we'll go ahead and do this. Well, the following week, it was announced, and I was able to call her back and say, okay, we can actually get started on the reverse mortgage right now. And just to give you an idea of who this person is, she owns a home in the Venice canals that was valued at $3.5 million. She had been, for many decades, the CEO of an apparel company and had a very high salary and was given a very high golden parachute when she left the company. But she was on pace to outlive her money. And that's when her financial planner thought that maybe a reverse mortgage would give her the funds that she would need to see her through the end of her life, or at least to see her through a time in the future when she may sell her home and downsize, which she was not ready to do, or to sell her home and relocate. And so it turned out to be an excellent solution to her financial issues. So I mentioned that there are loan amounts up to $4 million. So what does that mean? Well, I will say that we usually can lend, just speaking in generalizations, we usually can lend approximately 50% of the value of a home. The older a person is, the more we can lend. The younger they are, the less we can lend. So that 57-year-old borrower, who I just mentioned, we didn't lend 50%. It was a little bit less than 50%. But when I have someone who's in their 90s or their late 80s, it's going to be a little more than 50%. So keeping that in mind, we're able to give $4 million to someone whose home is appraised at approximately $8 million. And this year, I did have a couple former restaurateurs in Los Angeles whose home appraised for over $8 million. They were receiving care in the home. And one of them, the husband, was in hospice care, but he wanted very, very much to die in his home. And as my own father used to say, and which was able to be fulfilled for him. He always used to say, I want to be taken out of my house feet first. So we can all envision what that might mean. And this is why this family did a reverse mortgage, was given a line of credit of $3 million, and we extinguished their mortgage of $1 million. So they were given access to $4 million based on their home value of approximately $8 million. With a reverse mortgage, you can do either a refinance or you can do a purchase. A refinance, of course, is much simpler. You're in the home already, and we simply go through our processing and underwriting process. We do an appraisal on the home, and we then fund the loan. A purchase is a little bit different, involves a copy of the contract, appraisals to make sure that the value is there. And it is definitely, because you're receiving 50% of the appraised value of the home, if you're buying a $2 million home and you're putting down $1 million, it usually can mean that you can borrow approximately $1 million for the purchase of the home and never have any payments that you'll have to make. So it's very nice. It enables people to purchase more home than they might otherwise be able to purchase if they were paying cash. LTV offerings of a variety of pricing tiers. So with the jumbo reverse mortgage fixed rate, we have about 4 different fixed rates that we are using currently. The lower the rate, the less money that can be borrowed. And the higher the rate, the more money that can be borrowed. So something to think about if you hear someone say, I looked into the reverse mortgage and the interest rate is very high because my mortgage is very high. It could be because we are seeing they have $1 million or $2 million that we have to pay off. We're going to have to go with the highest yield program, which is also going to have the highest rate. There are fixed rate and adjustable rate options available. Now, you might be wondering, why would anyone do an adjustable rate reverse mortgage? And the answer is simple. When you are looking at a line of credit program, that is always going to be an adjustable rate mortgage. And that includes if you do a line of credit at your bank, that's not a reverse mortgage. It's always going to be adjustable. There is no such thing as a fixed rate loan on money that has not yet been borrowed. So with the adjustable rate option, it's actually very advantageous because the less money that you have outstanding as part of your loan balance, the less money you have that is subject to interest. So you're keeping, it is truly the most conservative use of a reverse mortgage. And of course, lower fees with no mortgage insurance premium. A lot of people may think, oh, a jumbo reverse mortgage is going to mean jumbo closing costs, but it's actually the opposite is true. On an FHA reverse mortgage, you have mortgage insurance that is required that represents 2% of the appraised value of the house. So if the home appraises for $800,000, there is going to be an upfront mortgage insurance premium of $16,000. But this is not the case with the jumbo reverse mortgage. So it brings down the cost of doing this mortgage. It brings it down significantly. I'm just going to have a peek at the Q&A right now. What are the current rates? Also, do you do more than 4 million? The current rates range from about 5.5%. It was 4.9, but that program has been discontinued based on the market conditions. With the inflation and the war in Ukraine, the rates have increased in all aspects of home lending, and reverse mortgages are no exception. So the current rates begin at around 5.5%. They go up to around 7%. And can we lend more than 4 million? No. We are not able to lend more than 4 million. Even if, and the 4 million is if the house appraises for 8 million or more. If the house, now, if you have a couple in their 90s and their house appraises for 3.7 million, or I'm sorry, like 5.8 million or higher, we may be able to give them close to 4 million. So that is how we are able to help them. Okay. In many cases with the jumbo reverse mortgage, if they are taking out a very large lump sum of cash, we can offer clients a lender credit to cover customary closing costs, depending on which interest rate they've chosen. If they're taking out $1 million or more, we're going to, in all likelihood, cover 100% of their closing costs. So they don't have to worry about any closing costs whatsoever. I mentioned already there is no mortgage insurance premium the way there is with the FHA program. You know, the FHA program is well known as a non-recourse loan, meaning that the borrower or the estate will never owe more than whatever is owed on the loan balance or the value of the property, whichever is less. The note for this mortgage also asserts that this is a non-recourse loan, despite the fact that there is no upfront mortgage insurance. It has all of the features, or many of the features, of the FHA reverse mortgage without having that mortgage insurance. Another application of this program is for non-FHA approved condos. A lot of times, a lot of buildings here in LA are not FHA approved. And so we are not able to do the FHA reverse mortgage for them, unless, of course, we go through a single unit approval process. The single unit approval process is also available for the jumbo program. And there are no prepayment penalties. You know, I've had couples do the reverse mortgage specifically because they wanted to wait until one of them passed away before selling the house so that they could get the step up in basis upon death. Well, what if that happens after 6 months? That's fine. There is no prepayment penalty because the lender realizes we are lending to people who are elderly in some cases. I had a client last year, who was 107 years old. And she made it to the finish line, which, you know, it's a very, obviously every day is, you know, is not taken for granted when you're 170 years old. But we got her through the process. Her son was her power of attorney and signed for her. But if she passes away in 3 months, there are no prepayment penalties. So that's good. Eligibility. Here in California, you only have to be 55 years or older. You have to be either a US citizen or a resident alien. If you are a US citizen or a resident alien and you are married to someone who is undocumented, we are not able to do the reverse mortgage. We always have to have every borrower on title have either citizenship or resident alien status. You must meet financial assessment qualifications. What does that mean? Financial assessment qualifications are relatively new. They were instituted in 2013. Do you know anything about reverse mortgages? In the past, and they have kind of a, there were times in history where they had a very poor reputation. And I think part of it had to do with the issue of financial assessment and that it did not exist. And now it does. And the reputation of reverse mortgages has greatly improved. So what do I mean by this? We make sure before we sign on the dotted line, we make sure that every borrower has been vetted. Can they truly afford their home? In the past, have they shown a willingness and ability to meet their household expenses? And if they haven't, how are we going to handle that? So we want to make sure that we're lending the money to the right people. If they are leveraged up to the hilt and they have not been making payments historically on time, then it may not be a suitable product for them. In which case I'll tell them that they may have no option other than to sell. But we do look carefully because, again, we care about the reputation of the reverse mortgage. And if we're lending money to people who are not suitable borrowers and who default on their taxes, their homeowners insurance, their HOA fees, it will ultimately be a bad reflection on everyone. So, and not only that, it'll of course put the senior in a very precarious situation. And no lender wants to have to foreclose on a senior. We look at the trust. Is the trust acceptable? Is it a revocable trust wherein the reverse mortgage borrower is the beneficiary? It has to be that way. And the borrower can only have one outstanding reverse mortgage loan at a time. So let's say, for instance, a borrower owns a house in Santa Barbara and they're looking to purchase a home in Oxnard, a second home. We would not be able to do a reverse mortgage on that second home. And that is because a reverse mortgage is designed for your primary residence only. You can't have more than one primary residence. Let's talk for a moment about the step up in basis upon death. Senior couples who purchased their homes in the 1970s for less than $100,000 may own real estate valued in the multiple millions of dollars. We know that this is the case. We see it all the time. It would not be wise for that senior couple, unless there is a strategy for dealing with their long-term capital gains, it would not necessarily be wise for them to sell their home while they're both still alive. If possible, it may make sense for the couple to wait until one of the members of the couple passes away in order to sell. And at that time, the step-up in basis is applied to the cost basis of the asset transferred at death, thereby saving the surviving spouse significant long-term capital gains. Okay, I have another question. Oh, sorry. That was the same question. I want to give you an example of borrowers that I've had who bought their homes in the 1970s, whose homes are now worth in the multiple millions. And we all know people like this. And so one of my borrowers is a person who was on a situation comedy in the 1970s. This is someone that is very recognizable to anyone over the age, I would say, of 50. So I knew this person. I was very familiar with her reputation, her performances, and I received a phone call from her estate planning attorney. She had been earning money by making appearances in Las Vegas. When the pandemic hit, she had, all of her live appearances dried up, and she had no source of income. Her home was valued at approximately $12 million. And she wanted very much to remain there. This home that she shared with her husband for many, many years was part of her identity. It was very important to her to remain in the home. And we were able to help her by doing the reverse mortgage, paying off her debts, and she has access to a line of credit of approximately $3 million. We paid off about $1 million that she owed on this home. So it really benefited her. And you may think of people that you recognize from having watched Johnny Carson years ago. You may think of those people who were guests on Johnny Carson as being infinitely wealthy. But as we know, people who are given a large amount of money at a certain period of time in their lives don't always manage that money well, and the money may or may not be sustained through their elderly years, which happens quite a bit, unfortunately. Okay, let's talk for a moment about a non-borrowing spouse. So I have a situation right now, in fact. I have a homeowner in the Palisades who is married to a woman. This is a second marriage. He has children from his first marriage. His wife signed a prenuptial agreement waiving all of her interest in the home. And she is not a beneficiary of his trust. And in order for us to do the reverse mortgage for her husband, for the borrower, we had to go through quite an elaborate process. I do want to say that on the FHA reverse mortgage, which is not what we're talking about here today, but which you have heard of, and it has a very low lending limit, so is not very often a great solution for homes that are worth multiple millions of dollars. But I want to say on the FHA home equity conversion mortgage, non-borrowing spouses will have lifetime rights to remain in the home. But that is not the case with the jumbo reverse mortgage. With a jumbo reverse mortgage, a borrower's spouse has to, on camera, acknowledge that they will leave the home and that the loan will be repaid, not necessarily leave the home, that the loan will be repaid within 6 months. And that can be either through a refinance, that can be through the sale of the home, or through life insurance, whatever it takes to repay. Obviously, if there is not a non-borrowing spouse, the same conditions apply. Within 6 months, the loan needs to be repaid either through the sale of the house or through the payoff using a refinance or life insurance. So we do generally recommend that couples with a non-borrowing spouse proceed with an FHA reverse mortgage. Non-borrowing spouse is somebody usually underage or someone who has quit claimed off title and never lived in the home. So when I say NBS, I'm talking about non-borrowing spouse. So they've either never been on title of the home or they've never lived in the home. So we ask for a letter of explanation as to why they are not participating as a borrower on the loan, and we have to be granted an exception to proceed. If the loan does not meet the requirements in the previous section and the borrower still feels that the proprietary jumbo is the best option, the non-borrowing spouse must be videotaped in an interview that must be completed in the presence of an attorney, a court reporter, and a notary. And during the pandemic, we've been doing these interviews on Zoom, and court reporters are appearing on Zoom with us. The notaries are going to the borrower's and non-borrower's home in order to verify the identity of the borrower and the non-borrower. Property eligibility. We can do a jumbo reverse mortgage on single-family residences, condominiums, 1 to 4 unit properties. We cannot do it on agricultural properties that are greater than 20 acres. We can't do bed and breakfast, boarding houses, condo hotels. We cannot do co-ops. We cannot do geodesic homes, income producing properties with acreage like farms, leaseholds, log homes, manufactured homes, mixed use properties, modular homes, and properties that are too close to a gas station. This was actually a nightmare I experienced a couple of years ago. A property that I pulled up to, took the application, everything was going fine until the appraiser came. I didn't realize that they lived one house in from the main road, and on that main road, on their corner, was a gas station. So they were within several hundred feet of the gas station, and therefore we were not able to do the reverse mortgage. The title cannot be held in business name, so we can't do a reverse mortgage on a home that's in an LLC. I understand if the LLC has been done for tax protection or asset protection, but that house, in order for us to do the reverse mortgage, would first need to be taken out of the LLC, put into a trust, and then we can do the reverse mortgage. In fact, I did exactly that last year. I had a borrower whose home was put in an LLC for asset protection purposes, and we were able to then take the home out of the LLC, put it in a trust, do the reverse mortgage. And here's an interesting piece of information. Because a reverse mortgage is recorded at 1.5 times the appraised value of the property, anyone who's a lien holder on the property may look to see that there's a lien that's recorded and that it's a very, very large lien, which I'll get into a little bit later. And they may decide to not pursue any collections pursuits against that person. I have another question, so let me see what that is. Is the change to age 55 just a California change or every state? So I'm seeing that in various states, the minimum age is now 60, but in California, it's 55. And I think Arizona, it's also 55. If you want to reach out to me for a list of the different states and the minimum ages, please feel free. I also want to say, since you're asking about other states, and I am licensed in every state except New York, the programs in different states are sometimes different. For instance, the hybrid lump sum line of credit program is not available in New York State. But please feel free, if you would like a list of the minimum ages, feel free to reach out to me. Okay, next slide. property details, as we've already said, it must be the borrower's principal residence. So I have had people come to me and, they've said this, this is my home. I've always lived here. And by the way, I have a home in Florida and I filed a homestead exemption in Florida. Well, that's not going to work, because if you filed a homestead exemption in another state, then that is now considered your primary residence. So you cannot have a homestead exemption in a state other than the state where we're doing the reverse mortgage on your home. So it is your principal residence. What does it mean to be a principal residence? It means that if there are investment accounts, credit card accounts, social security information, banking information, driver's license, social security records are all going to be in the address of the home upon which we're doing the reverse mortgage. And sometimes I work with borrowers in advance of doing their application to kind of get everything in order. Sometimes even the names can be different. I've had people give me a social security card that says, Irene Lewis. And then I have a driver's license that says Lynn Lewis. And the borrower will say, well, I thought Irene sounded too old, so I changed my name to Lynn, and it's on my driver's license. Well, what's on your birth certificate? Irene, we have to have everything match. So we do definitely investigate, is this the person's primary residence? If a repair set aside is necessary, the minimum is $500, not to exceed 15% of the loan amount. Okay, what is a repair set aside? If the appraiser goes to the home of the borrower to appraise the home, they're looking at a variety of issues. They're looking at cosmetics. So cosmetics could be chipping, peeling paint. It can be a floor that's pulling up. It could, most often, the most common problems I get really are chipping paint. But there are also health and safety issues. A health and safety issue is a handrail that has come loose. Another health and safety issue is a window that's broken. These are health and safety issues. Somebody could fall. We cannot complete a loan when there is an outstanding health and safety issue. Another health and safety issue, if the appraiser looks up at the ceiling and sees water damage, why is that water damage there? Is this a roof that is watertight? Are there plumbing problems? Any water infiltration presents a health and safety issue because it could affect the electrical workings of the home, and it could lead to a fire. So a variety of things need to be repaired in advance if there are cosmetics or health and safety. The repair minimum is $500. What if it's just like some chipping paint and it's estimated that it's only going to be $250 to repair that? Well, we would require the borrower to make that repair, and then we'll close the loan. And again, not to exceed 15% of the loan amount. We can't have a house that has so much deferred maintenance that the work required that it would almost be a full renovation. That's not what a reverse mortgage is for. So some work would need to be done. There have been times when I've done an appraisal, there was more than 15% of repairs required. And I'll say to the borrower, look, if you can see your way to get this amount of work done, we can shave off a few things from that punch list that the appraiser gave you. And then we'll be able to close your loan and get you the money that you need to make the balance of the repairs. Again, if we're doing a reverse mortgage on a property that's been purchased within the prior 12 months, we look to see what was the sale price of the home. And when we get that appraisal back, even if the appraisal is now higher, if we have the purchase that's within the past 12 months, we're going to cap it at the lesser of the appraised value or the purchase price. Just want to have a quick peek at the chat. Okay. And here is the question being asked. Okay, in the event of a jumbo line of credit is established via the reverse mortgage, is interest payable while the line of credit is not yet utilized? Nothing outstanding. And no, there are no payments. There is no interest accruing on money that has not yet been borrowed. And in fact, when there is a line of credit and that has not been borrowed, that line of credit on the jumbo program is actually increasing each year at 1.5%. So it's increasing as an asset to the borrower, 1.5% per year for 7 years. And the line of credit is available for a total of 10 years. We'll get into that a little bit later, but I want to say for my borrowers who have taken out the jumbo line of credit and they reach the 10-year mark and they have money left, my advice to them is always take what's left. And we may or may not in 10 years be able to refinance your reverse mortgage, but you'll have this money available to you. Draw it out at the end of 10 years. Okay. So the options on a reverse mortgage, on a jumbo reverse mortgage, we already talked about a fixed rate lump sum. Fixed rate lump sum is especially appropriate when an individual is paying off a very large mortgage. So if a home is valued at $3 million and the borrower is paying off a mortgage of $1,500,000, certainly makes sense to do the fixed rate lump sum. Let's talk about a fixed rate lump sum with a life expectancy set aside. If I have a client and I do credit history with them, we look at their income, and I see that they are habitually late on their real estate taxes. They have let their homeowners insurance lapse. They are borrowed to the hilt on credit cards. We may or may not have to do what's called a life expectancy set aside, where we set aside some of the money that we would have lent to them. And we use that pool to going forward, pay their real estate taxes and their homeowners insurance on their behalf. So money that we put in that set aside is not charged interest until it has been dispersed to the homeowners insurance company and or the tax collector. So when we do a fixed rate lump sum with a life expectancy set aside, that expectancy set aside may be very, very small if the person is in their 90s, or it may be very large if the person is in their 60s. So we need to underwrite every loan very individually, vis-a-vis what's the outstanding loan balance, what would the life expectancy set aside look like, what is the home value, how much are the taxes each year. All of these factor in to whether or not we can continue moving ahead with a loan where we have some delinquencies or derogatories on credit. Every loan is individually evaluated. And then we have the hybrid cash out line of credit. That is a program that requires a borrower to take 25% of available loan proceeds in the form of cash. So if, for instance, a borrower were allowed to get $2 million from their hybrid program, they would have to take $500,000 in cash. And the rest, 1.5 million, would be available to them in the line of credit. And again, that line of credit would be growing at a rate of 1.5% per year for 7 years and would be available to them for a total of 10 years. And the last program that I want to address is the hybrid cash out line of credit with a life expectancy set aside, very similar to the fixed rate. Again, after doing a complete underwrite of the situation for a particular borrower, their willingness, their ability to make their payments on time, we then make a decision regarding the life expectancy set aside. And again, if they're very elderly, that's going to be small because, we amortize it up to age 100. So if they're in their 90s, it's going to be a few $1,000s. If they're in their 50s or 60s, it will be a much greater period of time for which we are budgeting, paying the homeowner's insurance and the real estate taxes. Okay, and here we're talking a little bit about the rates, the rate options, 5.875, 6.375, and 6.99. The rates with life expectancy set aside are increased by 0.25%, and there is no servicing fee. On the lump sum hybrid program, lump sum line of credit hybrid program, there is a $20 a month servicing fee. Okay, so let's talk a little bit about this hybrid cash out line of credit program. The borrower has access to an adjustable rate product with a line of credit. It requires, as I mentioned earlier, a minimum upfront draw of 25% of the principal limit with a maximum upfront draw of 90%. So they can take 100% of the money that's available to them at the time of the funding of the loan. The line of credit is capped at 75% of the principal limit plus growth. There's a $20 a month servicing fee, an adjustable rate with a 5.5% floor rate. So what does that mean? The lowest interest rate on this program is 5.5%. It's based on the 3-month LIBOR. So what would happen if the margin for this program were 5.25% and the LIBOR were at the very minimum that a LIBOR can be? It wouldn't matter. We can't go below 5.5% rate on this. So the lowest rate, even if the LIBOR moves down to the floor, 5.5% is the lowest rate that we are going to be able to offer. As I mentioned earlier, a growth rate of 1.5% on the line of credit for the first 7 years and a draw period of 10 years. And then at the end of 10 years, my advice often is take out whatever is left, and we can either look at refinancing if the house has gone up in value, or at that point, you might ask yourself, is it appropriate to sell? So let's see here, the hybrid cash out line of credit program rates. So the rate is the sum of the margin. The margins can be anywhere from 4.99 to 5.5%, even a little higher at this point, I believe, plus the 3-month LIBOR. There is no rate lock available, meaning that if I take an application and it's 5.5%, and if the LIBOR goes up, which it is higher right now, then there is no rate lock period. Even if a borrower said to me, I'll give you, a few $100 lock in my rate, I'm not able to do a rate lock on this program. The rate cap is 5 points above the original rate. So if a person does close their loan at, let's say, 5.5%, the biggest rate they can have at any point during the life of their loan is 10.5%. And there are no caps on the monthly adjustment per month above and beyond the life of the loan cap of 5%. Now, I will say that, over the past few years, we've enjoyed very, very low rates and not a lot of fluctuation. Of course, now things are very, very different for all of us, not just for reverse mortgage borrowers, but those of us who have to put gas in their car, or, we're seeing so many things changing. Redraws and repayments. So as I mentioned, 25% of the principal limit on the hybrid program must be drawn at closing. And the remaining 75% is considered an open-ended loan and is available for future draws. And any future repayment reduces the loan balance and increases the available line of credit. So if all the kids, for instance, get together and say, we want to each put in about $10,000 toward mom and dad's reverse mortgage to keep the loan balance low, they can do that. And mom and dad will have an increased line of credit as a result. Any money that's paid back will increase the available line of credit. After closing, if a borrower makes an additional repayment, the loan balance decreases and the line of credit increases. And they can also redraw that money if they wish. So let's talk about how these reverse mortgages are recorded. Sometimes I get an email or a phone call from an attorney who says, I just pulled the title on my client's home, and I was shocked to see what their lien is on their reverse mortgage. It seems way higher than the value of their home. Should they just, leave the house and let the lender worry about it? And the answer is no. On the fixed rate reverse mortgage, this lien is recorded at 1.5 times the appraised value of the home. So if the house appraises for $4 million, the lien amount is going to be $6 million. So when you do pull that property profile, don't be shocked. Just know that this is not the balance that is owed on the property. In order to find out what is owed, you have to order a payoff from the lender. A reverse mortgage is a negatively amortizing loan that has no maturity date. Why does it have no maturity date? Because we assume that a person is going to remain in the home until they're passing. And that's the maturity date, but no one comes with a maturity date. So we don't know what that maturity date will be. Most states require a loan amount to be stated when recording. That is why we record at 1.5 times of the appraised value of the property. Now, on the hybrid line of credit, the loan is recorded at 3 times the available loan proceeds. So again, I've gotten phone calls from attorneys who are trying to help their clients maybe wrap up an estate, and they'll look up a property profile and they'll be in shock. Their client did a reverse mortgage on their home, and it now seems as though the loan balance is huge. But again, the only way to find out what the loan balance is to order the payoff from the lender. And it is recorded at 3 times the available loan proceeds. So if a person has a $2 million house and they are given available line of credit of $1 million, that mortgage is going to be recorded at $3 million. But they may have only taken out $250,000. That's why it's always important to order the payoff. So a couple of case studies. Terry and Maya are both 66 and would like to retire. Their home is valued at $2,350,000 with an existing mortgage balance of $400,000. Currently, their mortgage payments are $2,530 with 20 years to go. They have an investment portfolio worth $1,500,000. Their asset distribution rate due to the mortgage payoff is 6%. So there are several concerns there. their distribution rate is excessive. 4% is considered a safe rate. What happens if they continue with distribution rate of 6%? They run the risk of outliving their money, which, trust me on this, I'm sure you know this, that is a senior's most serious concern, outliving their money. In fact, some people even just make an assumption that they're going to outlive their money and end up homeless. It's terrible. So if investments underperform during the critical first 10 years of retirement, it could cause distribution rates to increase and further threaten asset longevity. This is called sequence of returns risk. If a person starts out their retirement while the market is down, it could permanently derail their retirement plans. Terry and Maya have no alternative income source for a poor investment environment and would be forced to sell assets at discounted values. And that doesn't even take into consideration the potential for having to sell the house while they're both still alive and potentially having long-term capital gains taxes. Using the reverse mortgage jumbo program for purchase. So the borrower must occupy the property within 60 days of closing. And we do ask for some sort of evidence of that. All of the Social Security identification, the banking information, credit reports, driver's licenses, everything should be turned over to that new address. Repairs must be completed prior to closing and paid by the seller. Now, in this climate, that's not going to be so easy. The use of a power of attorney or guardianships on purchases is not allowed. The borrower can own up to 4 financed properties, including the subject property, but only one of them can have a reverse mortgage. As we said before, it has to be the primary residence, and you can only have one primary residence. Let's talk for a moment about powers of attorney, guardianships, and conservatorships, which I have to say is the lion's share of my personal business. So there are 2 different sets of circumstances here. One is a power of attorney for someone who's physically incapacitated, a stroke, ataxia. There are a number of reasons why a person may need another individual to sign on their behalf, and mentally incompetent. They have dementia. So those would be 2 reasons to have a power of attorney. In order for us to utilize power of attorney, we need for that power of attorney to be in force, particularly in the case of mental incompetence. We need that power of attorney to be in force way before the event which deems the borrower mentally incompetent occurs. So we require letters from doctors actually looking at the dates at which a person was still considered competent and the date when they were no longer competent. We want to know that when that power of attorney was executed, that person was competent to sign over power of attorney to the person that they appointed. Guardianships and conservatorships, temporary guardianships or conservatorships are not permissible for reverse mortgages. The guardianship or conservatorship must be valid, in force, and with no expiration date, so that the borrower has a legal representative for the life of the loan. So let's get into the weeds a little bit more with the powers of attorney, guardianships, and conservatorships. When a power of attorney is representing a borrower, as I mentioned, we need a doctor's letter attesting to the competence of the borrower at the time of the execution of the POA. The doctor's letter is also required, sometimes by the same doctor, attesting to the current incompetence of the borrower. Some trusts, and I've seen several of these, specify that 2 doctor's letters are required in order to utilize the POA, in which case we need 2 letters. And what I'll do in these cases sometimes is I'll get the first letter from a doctor saying that the borrower was competent when they executed the POA, and then I'll get another letter from a different doctor saying that this person is no longer competent. Whatever medical documentation was provided to the court at the time will suffice for conservatorship and guardianship, because obviously, if a judge deemed that a guardianship or conservatorship was necessary and they used the documentation provided them by a physician, that's good enough for us as well. Financial assessment. We got into financial assessment a little bit earlier in this presentation. So when we do financial assessment, we're looking at income and assets. Some people, many people, in fact, are down to their last nickels and are using just Social Security income. But that's okay. We can usually lend to that person because there is no expectation that repayments are going to be made. There is only the expectation that the borrower is going to have the wherewithal to pay his or her taxes and homeowners insurance, and of course, to keep the lights on in the house, to afford groceries and utilities, which we do in a very rudimentary way calculate. If their income, and mind you, borrowers generally who have low income, if they've been in their home for 40, 50, 60 years, guess what? Their real estate taxes are also very low. So that's great. We can help that person because in some parts of the country, real estate taxes are one of the biggest obstacles for us to be able to help someone. I came here from New Jersey 12 years ago. New Jersey has among the highest real estate taxes in the country. So doing reverse mortgages in New Jersey is somewhat complex. But let's say, for instance, that the person has very low income, but they have $1 million put away. We can assume, we can dissipate those assets. We'll say, okay, this person is 80 years old, they have $1 million. We can make an assumption that those assets can, over time, be dissipated to meet the expenses of this household, vis-a-vis homeowners insurance, real estate taxes, groceries, utilities, etc. We look at their credit history. If they owe $500,000 in credit card bills, this could be problematic because, especially if they're not making timely payments. We're looking to get a very big picture of their credit history. And sometimes we find out at the bitter end that we have a problem. If we usually don't pull the homeowners association payment history until the very end. And if they've been delinquent on those payments to the homeowners association, if they live in a home that is part of an HOA, in many cases, we can work around it, but we need to create a letter of explanation for extenuating circumstances. So I'm a very creative writer, and I have written a lot of letters that have been able to explain away late payments. But during COVID, it was very easy to do that. I had a very lovely lady apply for a reverse mortgage. She had some late payments, and she said to me, listen, Janice, I was paralyzed by fear. I didn't leave my house for a year. And I had a couple of late payments, but it was because of COVID. Once I was vaccinated, I felt more confident. I relaxed a little bit. I started to regain control over my finances, over my life. So in many cases, during the past 2 years, it's been very, very easy for me to do my creative writing. We look at the property charge payment history, taxes, HOI, HOA, residual income. Are they at a loss every single month? Are they $500 short every single month, even with the proceeds of the reverse mortgage? Sometimes that happens. If their real estate taxes are very high, as I said earlier, it can be problematic. We have to see that with the reverse mortgage, they're going to be flush, and that we're going to be able to show that they're going to have enough assets that they can pay for all of their household expenses indefinitely. And most people do pass that underwriting, underwrite of financial assessment. All right, extenuating circumstances, as I mentioned before, I'm a part-time creative writer. If a borrower fails the willingness test, Mutual of Omaha considers extenuating circumstances beyond the borrower's control. So what are some extenuating circumstances? COVID, loss of a job, illness, death of a spouse, death of another family member. I've had to provide death certificates to the underwriter to show that this was an isolated instance as the result of an illness, a death, a loss of a job, and that going forward, the borrower has everything that he or she needs to be able to meet his or her expenses going forward. Compensating factors. If a borrower fails the capacity test, meaning do they have enough money each month to meet their expenses, Mutual of Omaha considers compensating factors that offset the income deficiency. And that would be assets put away with a financial planner. We can't use, money stuffed in the mattress, unfortunately. That would mean alimony. We can take all kinds of income, assets. Also, as I mentioned earlier, dissipating the proceeds of the loan or dissipating the assets. We'll figure out a way most of the time. Life expectancy set aside. So we call that a LISA in our industry. Maybe a loan requirement if a borrower fails financial assessment. A LISA is used to set aside funds for property taxes and insurance. Now, sometimes a person will come to me and ask if they can have a LISA. It does increase the rate slightly. With the FHA reverse mortgage, that is not the case. It does not increase the rate. But I don't normally recommend it, but there are people who like the idea of having a life expectancy set aside, but there are other options for a person who is kind of losing their ability to remain really on top of their household expenses. And that could be maybe a daily money manager or a personal bookkeeper. And we can recommend that they, seek out someone like that, because very often a senior is perfectly competent to remain in their home. They may need a little help here and there. So that is something that we can all collaborate to get for them. Appraisals. We are at the mercy of appraisers. Right now, they are extremely busy. The refi boom seems to be over, but for whatever reason, we're waiting a long time to get appraisal reports back. But we don't order appraisals from appraisers. We order appraisals from appraisal management companies. So we have several appraisal management companies with whom we work. For properties that are under $2 million, one full appraisal is required. And for property values over $2 million, 2 full appraisals are required, and the lower value is used to calculate the loan. So refinance. We can't just refinance every 6 months or however often a person may call us and say, hey, I think our home has gone up in value. We'd like to get more money out. There has to be a bona fide advantage to the client by passing a closing cost test and either loan proceeds test or the rate reduction benefit test. So if there is a true benefit to the borrower, yes, we can do a refinance, but we are not, Mutual of Omaha is not a company that tries to frequently refinance our clients unless it makes sense. There are reverse mortgage companies out there that seem to target refinances, and it can be a little predatory. I don't like it. But I will say sometimes it's warranted, but many times it's not. And if you put a client in the right program from the start, very often they won't need to do a refinance. So we also look at the closing cost test. As I mentioned, for very high value homes, we can sometimes do zero closing costs. So very often that enables us to do a refinance if it makes sense. We won't charge closing costs all over again, even if we've had the borrower pay for title and escrow. Loan proceeds test. Are they getting more money? Are they getting 40, 50, $100,000 more? And a rate reduction benefit test. Like right now, obviously, we're not doing rate reductions because that's just not the climate at this moment. But back when we were able to offer a 4.9% rate, we were doing a lot of rate reduction refinances where people were sometimes even not getting any money out of the reverse mortgage. They just wanted to lower their rate. That is my presentation, and I would love to hear if you have more questions.
Janice is fantastic. And how about this? This is the first we went over about 20 minutes, but it was so compelling and so interesting that I didn't even say a word, because I'm sure by the people on the line, nobody else wanted to say a word either, because they were listening with bated breath for all of the diamonds of information that came out of the presentation. So we've run a little late, and you took some questions during the presentation. So I think maybe if anybody has anything else, they could contact you directly. And already, thank you. Good presentation is popping up on the box. It was really great. I mean, I learned a lot, and I operate deeply in this space. So if that's the case, I'm sure everybody got a tremendous amount of information, knowledge, tips, sage advice from the presentation. So Janice, thank you so much. Thank you everyone in the Zoom audience, and we'll see everybody for the next program. Fantastic program.
Thank you so much. Sorry for going over, but
that's okay. We wanted it. That's why I didn't, everybody wanted it, so they stayed on. Okay. Thank you everyone. Bye-bye.